Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today our guest is Mike Zlotnik. Thanks for being on the show, Mike.
Hi, Whitney. Thank you for having me on the show.
It's a pleasure to have Mike on the show. Mike is a debt and equity investor in real estate. He's CEO and has since founded TF Management Group, LLC, author of the book called How to Choose a Smart Real Estate Investment Fund, and has a podcast called The Big Mike Fund. So look him up, look up his podcast. And Mike, tell us a little bit about yourself, how you got into real estate and what you're currently doing.
Sure. Thank you, Whitney, again for having me. I've been in real estate since 2000. I spent actually almost 15 years in software development. In 2009, I quit that industry, retired from it, being senior executive, and went real estate full time. It's been my passion, and there's nothing more exciting to me than looking at real estate deals, and that's what we do. And been a little bit of an educator as a side business. So bigmikefund.com is the website where the podcast lives. I do have the book out on Amazon, but my day job is a fund manager to look at syndicated deals, other funds, loans, and that's what I do day in and day out. I live in Brooklyn, New York, married, 4 kids and a cat, and people call me Big Mike or Big Russian. That's it.
Cool. So, for the listener who's not exactly familiar with what a fund manager does or what that is, could you just elaborate a little bit on what a fund is and what you do to manage it?
Sure. So people know what is a fund. They've seen many of them on Wall Street. We run a small fund. There are Wall Street funds, typically known REITs. In real estate, that is your classic fund. In the big fund, big REITs typically have concentration. You will hear multifamily REITs, you will hear office REITs, you will hear retail REITs, and so forth. So they exist. They're typically $1 billion plus funds, and then they have syndication. They're publicly traded securities. We're different. We're a private fund. Investors in our fund put the capital. It is a pooled investment vehicle. So we have many investors that invest in the fund. And when we break the money into many investments across the board of different types of real estate investments. So we are a diversified fund, so we invest in self-storage projects, multifamily projects. We invest in retail projects, office space. We make hard money loans secured by real estate. So it's a diversified portfolio, but that's what the fund looks like. Many investors put the money in, and then the fund manager's job is to pick and choose the best opportunities and invest into them. So that's what it is. Diversified vehicle. It's a pooled investment vehicle.
Nice. So how long have you been in this role as a fund manager?
I've been doing this since 2009.
Wow. Okay. So what is it about, that caused you to want to be a fund manager, as opposed to maybe syndicating your own deals or, and navigate us through that a little bit?
Whitney, that's a great question. So, it's a brilliant question, I have to say. The big difference is that I don't do my own deals. Well, I do them to a much smaller extent. So I have some investments, and I own real estate, but generally I own it for long term. And as a fund manager, it's a combination of picking and choosing other people, other project sponsors, the best of the best people who have high integrity, high experience, high abilities to find projects and to run them through their life cycle. That's my job. It's not to find necessarily individual deals, but to find project sponsors, we call them, or the borrowers who are good at what they do, and they're good people. That's the job number one. My job is to find people. The job number two is to fund their projects, to go each relationship deeper, understand what their needs are, what kind of projects they're doing, and there are specialists. We have relationships with multifamily specialists. We have relationships with retail in Southeast specialists. We have relationships with self-storage specialists. Each of these relationships is what we develop, and then we fund their deals as they come through the pipeline. So from that perspective, the difference between a fund manager and an individual syndicator is we're not syndicating deals. We are finding the right syndications with the right sponsors. We will often influence the syndication terms because we could provide them with a lot of capital. We want to make sure the syndication is fair. So that's what we do. We don't just pick and choose deals. If a deal looks great, but the terms don't look good, we'll try to influence it. If we can get the terms to be fair, we'll pass on. So
nice. So I mean, you're vetting the sponsors, you're vetting the deal, obviously for your investors or for the fund. But let's go into like, what does that relationship look like between, someone that's a fund manager and somebody that's a deal sponsor? They, how do they connect with somebody like yourself, and what does that relationship look like?
So it's another good question. Number one, we don't take any cold calls from the street. So you got to come with some kind of referral. I don't know how you got to figure it out. Who knows me, but you got to do that. So if you have a great deal and really somehow get referred to us, we'll chat. We'll understand your business, who you are, just who you are as a person, what kind of deals you do. Do you have a pipeline? Is it your first deal, and so forth? If you have a first deal and you have a great opportunity, it might help you find another co-sponsor. It's another thing we do because we have all the connections. So if you find, I'm going to give you an example. You go to some self-storage conference and then you find a great piece of land for development or some old building for redevelopment. And then you reach out to us and say, listen, I'd love to do this deal. The numbers look great. I order feasibility study, this and that. I don't have a co-sponsor. Without co-sponsor, getting financing is hard. Running through the life cycle is hard and so forth. But for the moment, just say you're an experienced syndicator and you have your own deal flow. And somebody refers you to us. We'll gladly look at what you're doing, what experience you have. We look, interestingly enough, I'm working on a presentation now. Again, this is educational content. It's not designed for any other reason other than people have asked me to share some of the thoughts, how to underwrite these deals. And part of that is looking at sponsor underwriting, deal underwriting, financial terms underwriting. So we'll look at everything you got. If you have an OM, you can come with an offering memorandum today. We can look at it right away, and we could say, hey, listen, this looks pretty good. There's a good possibility we'll invest right away. Or if we don't like it, we could provide our feedback. So that's kind of the new relationships come to the pipeline, and then existing ones, I try to maintain them. I mean, we have deals with people, and we'll do as much as we can. Try to talk to them ongoing, break some bread, meet up in person. I go to a number of masterminds. I say, I see these people regularly, and try to understand what's happening in your business and how it's changing, because things are changing all the time. So that's sort of, I don't know if it's a long answer to a short question.
No, it's good. It's good. Yeah, I mean, and you answered it. How do people get in touch with you? And obviously they need to come through a referral. And then, so, how do they present a deal to you? Let's say we've got a referral. What do you like to see? And what are you seeing right now in deals, good or bad?
So assume the referral, if you figure out there's some kind of an established chain, I'm not trying to push people away. If you have a good deal and you go in a big Mike fund, you get a hold of me and then you reach out, we can still talk. But you'll certainly get less priority if you come as a referral for somebody really good. So we'll look at the person first. If the person is good, then we start looking at the basic summary of the deal. So what is the value add? We don't like retail deals. We don't want people to come in and just buy retail. Although there are deals that are fully operating. Give you an example. We're looking at a couple of deals right now in retail space where REITs are selling and a very, very experienced operator is buying. They're typically Class B retail shopping centers, non-anchored, or maybe anchored by a supermarket, but not by big box store. We're absolutely conscious of Amazon effect and that kind of risk. So service-oriented shopping centers, they're shedding them at the cap rates, in the 9%, which is, if you leverage that with good bank debt, you can get easy teens cash on cash from day one. Plus, some of these deals have good value add. Classic value add in retail, for example, selling out parcels, developing and selling out parcels, or selling existing out parcels, changing quality of tenants, and so forth. Again, I'm using an example of a retail. So we'll look at the deal, we'll look at the value add plan. If it's a self-storage facility, what's really, really popular nowadays are the conversions. So you have ground up developments, but you also have conversions. Old Macy's that has gone out of business, or Toys R Us, or Sears, or Kmart. They are well positioned in a given city. And you look at the feasibility study, you look at the surrounding areas, there's nothing close to it. So the theory behind conversion is good. And then you go look at the dynamics of actual financials. What is it going to look like? What are you acquiring it at? What's the additional work required? How long it's going to take? What additional things you have? Is there some small retail around it? Can you do anything else? What else can you do with land and the buildings? So, and what's the final product will look like? How long it'll take? Then assume the project itself has very strong economic sense. You know, you're picking something up for $1 million, you're investing $1 million, using an example, okay? And this thing is going to be worth $4 million. So you're going to double the value, and the doubling is going to happen in 3 years. Okay? Just for the sake of a discussion, okay? And on top of that, it'll get some cash flow, and you go through the very basic kind of, you leverage that with some bank money, and before you know, you have, very strong IRR. So the next piece that we look at is fairness of a deal. I've seen sponsors coming in. I literally have a deal right now. I'm not going to name any names, but to the point where there's no pref on the deal. It's the very, I don't want to call it ugly deal, but on the border of ugly. Really good sponsor, very, very experienced, looking for very easy money. So they're offering investors 39% of the common equity in the deal, on that particular deal. And they're offering zero pref, and the investors put up 100% of the money. When I look at this deal, I say, you're brilliant as a sponsor, you're so nice, but you're not taking care of your investors. Right? If the deal goes great, they'll still make a reasonable return. But if the deal goes so-so, you'll make a lot of money, they won't. I mean, it's good for you, not good for investors. My job as a fund manager is to make sure it is good for investors. Now, some sponsors will say, well, I could raise easy money from mom and pop investors who don't know better. Sure, so much more power to you. But you're going to run out of those money, number one. Number two, when there are any kind of ripples in the water, people are going to get away from, they're going to get nervous. So we provide very reliable capital, but we want a fair structure. So what is a fair structure? I'm just going to throw a number on the table. It's got to be a decent pref, from 8 to 12% typically, sometimes high, sometimes lower. And then there's got to be a fair split. So we have many deals with 70-30 splits, 70 to investors, 30 to the sponsor. And then it changes once they reach, say, 18% IRR. Okay, at that point, you've generated investors 18% annualized, you can keep 50% of the upside. But you certainly can't come to the investors and start with 61% return to the sponsor from day one and no pref. I mean, that boggles my mind. But these type of deals do happen. People bring in deals that look like that. Does it make sense?
Yes, it does. It does. So tell us maybe about a recent deal that was structured the way you liked it, or maybe the way you negotiated with a deal sponsor to come to terms that both of you could agree on.
Sure, I'll give you some deals we've done recently. Heavy value added. I'm not going to name any names, but sure. It's an extreme example of extreme high pref. This is the highest pref we have. So we have a deal with a bright, very good project sponsor, and they come with a 10% pref. Again, just heavy value add multifamily, heavy, a lot of work. And they wanted to give investors 20% equity and 10% pref. That's all it is. It's just paying 10% as you go. And then when they refinance, the exit strategy was, by the way, not sale, but refinance. And there are multiple assets involved. So they could refinance them as they make progress in individual assets, paying down the debt initially, and then refinancing with cheap bank long-term money. So initial financing is hard money with an equity piece. So we're talking about equity participation in the deal. So ultimately, we've taken the deal through a series of discussions, and we sort of took control because we brought in the last kind of money to the deal that made it happen, and wound up with 24% pref and 25% common equity. Now you're going to say, this is crazy, you'll pay 24% pref. Well, you have a choice. The deal will happen or it doesn't happen, and you're getting us as a sort of we're not a working partner, we're mostly passive, but we will help as much as possible, and it's a long-term relationship. So that deal is a strong deal. Now it still needs to go through the life cycle. The rehab still has to happen. The value has to be increased. But in that deal, I consider it to be a pretty strong sort of a sponsor. It's a balanced deal. Let me put it this way: the sponsor will wind up with 75% of the equity, which is higher than in other deals. But because they pay such a high pref, they're very motivated to get the project over life cycle, refinance, repay principal of capital, repay the pref, and then they keep 75% of the upside from there. Does that make sense?
Yes, it does. It does. And I wish I could ask you to like break that down a little more for the listener who can't follow probably that fast.
I certainly can. So
yeah,
the way it's going to flow is on a high level, it's a multi-million-dollar deal. It's a significant. It's over 700 doors in multifamily. So all these buildings are old. They've been run down. They had very low occupancy to start with. And they're going through heavy renovations. Roofs are changing, electric, plumbing, inside of units, outside. Everything is changing. It's going to be brand new, almost. It's unbelievable what's going to happen from a really old, crappy apartment complex falling apart to fully operational, something that people can be proud of to have in their city. And from a finance perspective, let me put it this way. I'm going to use rough numbers, okay, just to give you an idea. There's a $20 million first lien mortgage, hard money loan, and then the equity is $5 million, just high level. And when the project is done, after the buildings are renovated, restabilized, that project is worth $40 to $45 million, right? Because it's such a distressed project. By the way, the amount of renovation is higher than the price paid. So of the capital, the renovations cost more than the acquisition. So you can imagine how much work it is. Okay.
Yes.
And upon completion, that $20 million first lien mortgage will be completely repaid and cycle through with a new set of, it's just, again, it's a multiple assets, so it's going to be multiple separate mortgages. But conceptually, think of it, one big pool. There will be a new $30 million first mortgage. The property will be worth $40+ million. It should be very, very doable based on projected numbers and how banks land. And the $30 million repays $20 million hard money loan. It repays $5 million equity with a pref, which is 24%. Even if it takes 2 full years, that only will consume enough of the $5 million. It'll be roughly 48% on that. So it'll be $2,400,000, right? So it's $30 million refinance, 20 to pay hard money loan, and then the rest will pay $5 million equity, $2.4 million preferred interest, preferred return, and there's still a couple $1 million left as a buffer. So when it's all said and done, the asset is fully repaid. All investors are repaid in full with their principal and the pref. And then what's left is a building worth at least $10 million in equity, right? So it's 40 plus valuation minus $30 million mortgage. So it's $10 million equity in that project with a very strong cash flow, very, very strong. It's going to be, I don't have the numbers off the top of my head what the cap rate, but it's going to be double-digit cap rate because it's acquired at such a, and the project sponsor will wind up effectively owning $7.5 million worth of equity in that project. Does that make sense?
Yes, it does. It does. Yeah. So what was the, I guess, initially going in, how much do the investors have? I missed that part, or compared to.
Again, they raised $5 million equity. So okay. We came in ultimately with $1 million as the last drop in the bucket, right? They had sort of raised 4, but they didn't have enough. So when you come in with less money, it's the most powerful money, right? So the sponsor gets suddenly very, very flexible to get that last $1 million to get it done. And we're not trying to put a squeeze on the sponsor, but we're able to certainly run the deal through our own lawyer and have parent company to be Delaware holding companies with if they fail, we can step in and take over that entity quickly. If they perform, our job is to be as passive as possible, let them run the show if they're good people. If they're able to run it through life cycle, even close to what's been projected, that's already good enough.
Now, I'm glad you touched on that as long as everything's going smoothly, your job is to just stand back and be passive and just really monitor what's happening, correct?
Yeah, that's exactly correct. I like, you've heard Warren Buffett. I mean, this is the Oracle of Omaha. He's the brightest and best investor of all times. Well, I don't know, one of those people. So I like what he says and what he's written. Essentially, as a fund manager, or I mean, he is effectively a big fund manager. He's the biggest in the world, right? What does he do? He does only three things, right? He chooses people who work for him or who he invests with. And in his case, he has all these subsidiary companies. So he chooses the right people, and he decides how much money to invest in each company or each opportunity or each business. And so he chooses projects and dollar amounts. That's it. That's three things. That's what the fund manager does ultimately. And then after you make the investments, the job is to monitor them, is to make sure that they perform. If they don't perform, you have to make adjustments and corrections.
No, I really appreciate you going through that, Mike. I know that's very good content for the listeners, and just breaking down what you're looking at, and that's kind of a different type of deal than what I think most people would see, and how that's structured and what was the whole period? What was the length of time until that happens, till it's finally refinanced at the end?
So it's another great question. Obviously, every project we invest in, we always think of an exit strategy. That's the number one question. What's the exit strategy? And we certainly want to know approximate timeline. We realize things don't go always perfectly, but a range is a good way to go. So this project is sort of underwritten for 24 to 30 months as a way to get it fully stabilized. The actual progress will be in piecemeal. As each building is renovated and stabilized, it'll go through refinance. In the most optimistic case, I think it's 18 months, and sort of a backfall is 30. Even if the project runs 36 months, it'll probably be totally fine.
Yeah. So Mike, what are maybe some other exit strategies that you would look at, or that would be preferable, on the fund side that you like to see?
So generally speaking, I like to see projects with dual exit strategy as much as possible. Most of the projects we invest into should be underwritten for long-term hold. Like Warren Buffett, I like projects that we invest to own indefinitely. Not necessarily it's going to happen, but it would be good to be able to prepare for market to turn and to survive downturn and be able to cash flow the asset even if the values have gone down. So I very much like, as part of the underwriting, to be able to cash flow. So ultimately, every project, every asset, even if it's a ground-up construction with no cash flow for a couple of years, it's got to have a stabilization lease-up period, and the number of those projections need to be there. So we're prepared to hold it for, say, 5 years plus. At the same time, a project that does have an early refi helps. It doesn't have to be there, but a dual strategy as a refinance and then hold or sale after 5 years are generally pretty acceptable. What I do like also, opportunistic sale to be added. So we have investments in the ground-up constructions of, again, another self-storage facility that is going through full lease-up. But because the market is strong today, the sponsor of that project will try to market the property today while REITs are paying still top dollar for this type of assets. So it's preparing for the long-term hold, opportunistically selling it if the price is right, and then having a refi as a third strategy. Not every asset has to go through this, but it certainly helps to have that kind of flexibility.
So, Mike, when someone comes to you and says, I'm looking to get started in this business, what's your, just 30-second to a minute spiel that you would give them, and just some advice on how to get started in either syndication or even being a fund manager?
So if you're looking to syndicate, number one, find somebody who's really good at this. So find somebody who has experience, who have done similar type of projects. And syndication is just a vehicle, a mechanism how you raise capital. So you need to find a strong business. So if you're doing multifamily, it's really important that you work with somebody who's a specialist in multifamily. If you're doing self-storage, it's a specialist. Retail, it's a that specialist. Office specialization. It's a game of specialization. Once you learn the ropes, then you could sort of potentially venture on your own. And if you are doing one of your first projects, don't be greedy. That's my advice. Find, let's call them an experienced partner. You can have different type of partners. You can have credit partners, you can have experienced partners, you can have money partners. So having an experienced partner and a credit partner is very important. So I would say find a good co-sponsor, and that's your key success factor. And if you're looking to start a fund, Well, ask yourself a question. What do you need the money for? I literally have today a gentleman who was looking to start a fund. My first question to him, my first feedback to him is, what business are you trying to fund? Do you really have a legitimate business, whatever you're going to do, whatever type of transactions, that you can't fund without a fund? Fund has a complexity level of its own. So if you're a good operator of those type of deals, then just focus on that. The money is the easy part, in my view, if you have quality deals. If you don't have quality deals, you just want to raise money first and figure out what to do, well, money is going to burn a hole in the pocket.
What would you say is the hardest part of being a fund manager?
It's another good question. I have to think about it for a minute. Some of it is portfolio management. It's stuff that I don't always enjoy. I wouldn't call it hard, but it's something that the bigger we get, the more time I have to spend managing the portfolio. It's not always the most exciting part. So some parts are running just fine, but we still need to provide investors update. What we do is very different from many other funds. Some funds, you just put the money in and it's a black box. We run the fund, or at least I am co-manager, I run the fund as a white box. We actually present to investors what's in the portfolio and how it's doing. So keeping investors updated frequently is work. It's hard work, and that's what we try to do. It has a lot of benefits because they feel informed, they feel they know what's going on, but it's an extra effort for me as a manager. I don't know if it's the hardest part, but it's just it's a little bit time-consuming part for sure.
What's the best way you found to communicate with investors and stay top of mind like that?
Well, we do a couple of things. So one, we use a MailChimp as one of the platforms. So we use this to basically send emails to the email groups. And we send quarterly updates. We also do quarterly presentations. So just like you can have corporations on Wall Street have quarterly calls, we're trying to do quarterly calls. Well, we're doing them. We're not trying to do. We're doing quarterly calls every quarter. And that helps. PowerPoint presentation slides plus Zoom conference call, and then we supplement that with MailChimp blasts with sufficient information. So it's some kind of a report without overwhelming them with too much information. I find that pretty good way to communicate with investors. Plus, we do go to events and we actually communicate with them in person as much as possible if many of investors come to the same type of conference. But day to day, frequent updates, not overwhelming, but enough to give them useful updates.
What type of CRM do you prefer?
We use Podio. I mean, I don't have any preference. It's a good platform. I mean, it's customized. So whatever you want to customize, when I was in the corporate world years ago, I used Oracle, and we use what the hell was it called? I'm blanking out. Salesforce.
Okay.
Those are big professional platforms. They're overkill for small businesses. Podio works for a lot of small corporations or small businesses.
So what's a way that you've recently improved your business that we could all apply to ours?
I would say taking a step back and looking at the bigger picture. Sort of going back to the basics, rethinking about core values, why they're important. Well, I'm directing my team to think about what people we want to work with. Are they great people? They're meeting the core values, are they idiots? So people kind of rating every relationship you have. So rate your customers, your investors, your closers, your marketing people, everyone you rate 1 through 5. The good old, if you follow Jibo, straight from the gut, and some of the other methodologies from the great minds of corporate world. But conceptually, it works the same way in small companies. You rate every relationship you have, and 1 through 5. The 5s are your best, the 1s are the worst. Okay, so focus on the 5. Spend as much time. It's an 80-20. Probably giving 80% of the business, 20% of the people. So nurture those relationships. Focus on identifying first what they are, who they are, and why they are, and then spend more, and then find every reason to cut the 1s and 2s. The 3s you may give them opportunity to shape up, but the people who you don't want to work with, exit those relationships as soon as you can, as fast as you can. Save yourself time and energy, surround yourself with the best people. And that's the kind of thing that you need to constantly think about. At least if that's in your mindset, you'll consciously focus on working with better people instead of working with worse people. And often you're forced to work with worse people because there's a problem when they're annoying, they're aggravating, they're consuming your energy cycles, and you want to find a way to not to do that, but focus on the best rather than the worst.
Nice. What's the number one thing that's contributed to your success?
I want to give credit to my mother upbringing. She's a very hardworking woman. God bless her. She's 88, hanging in there, and she just taught me to try to be humble and to basically work hard. There's nothing fundamentally wrong with great work or smart work and everything else, but thinking about hard work, and not only hard work, but also my mother is an incredible giver. So the most important thing in life is to help others. So whenever I can, I just think how I can help somebody else. Extend the giving hand. Think about helping others rather than helping yourself, and that will go a long ways. So that
was going to be one of my next questions. Is how do you give back?
You give back. I mean, I participate in a number of give backs as part of organizations I'm involved with, masterminds, as much as I can, and I contribute with money. But also, I do help some folks in need, who, good people, but they just can't, So I try to give people some useful feedback, yeah, I mean, at every interaction, what I don't do, and some people do this, they have purposeful, I have friends who will go to Mexico and build houses for poor, right? There's very specific things people contribute. Years ago, I used to be involved with Starlight, Star Bright foundations. But now, just in every interaction, every younger person I meet or something, just try to chat with them and see, where do they need help, and if they need help with something, that's what you can do every day in and day out. I don't have a specific charity, but I'm involved with a number of other charities people run, and I contribute that way.
So, is there a need in your business right now that you would like to tell the listeners in case there's somebody that can help you in that place?
Sure. So we're always looking for great, deal flow, and always looking for capital. It's funny how this whole business is marriage of monies and opportunities, and it never ends. So if you're an accredited investor and you have capital and you want to look at our funds, please reach out to me, bigmikefund.com, and I'll send you a private placement memorandum and other information presentation. And if you are a deal maker, mover and shaker, and you have quality deals, and even if you don't know me, we'll have a conversation, right? I mean, I can quickly figure out within a couple of words whether it's worth step two. So I have limited time. I'll do the best I can to help you out if I can with advice and some feedback. And if it's not something that I can really help you out with, we'll just part the ways. So
nice. Well, Mike, how can listeners, is there any other way they could get in touch with you or learn more about your business, or bigmikefund.com the best way?
Sure. So there's also a primary website, tempofunding.com, from the word temporary, TEMPO, tempofunding.com. But bigmikefund.com will take you to the same place. It'll just land you at the podcast page. So it's very easy. I came up. Don't laugh at this. Most people will really get this joke. So I was talking to another gentleman on another podcast, and when I said bigmikefund.com, he heard bigmikefun.com. I thought, what kind of a kinky site are you running? I said, I don't know, but it ain't me. 5 minutes after the call, I went to the GoDaddy, and that site was not taken. So I grabbed bigmikefun.com. So if you misspell it, it's not a kinky site. It's just
okay.
You'll wind up in the same place. You could email me, mike@tempofunding.com. That's my primary email. And that's it.
And then also your book, right? How to Choose a Smart Real Estate Investment.
Yeah, it's a book on Amazon. I can show you the book. I have the book over there. Just throw one right here. This is the book. I don't know if people see this in the video.
Yeah. Nice.
So it's on Amazon, called How to Choose a Smart Real Estate Investment Fund. Just go to Amazon.com, Google Mike Zlotnik. It's available in Kindle version. And it's a small book. It's, it's 30 pages. I don't know how much. It's a very small book. I need to do version 2.0. This is this whole book talking about, if I want to give you some listeners some feedback. So if you have a great idea, great thoughts, the way you write a book, you talk through the book. So the way I wrote the book is I created audio version first. I had the skeleton, the content, had an interview with a good friend, Corey Boatwright. And I've ever heard of the guy. He's a pretty well-known dude.
Yeah, I know Corey. He's a friend. I like him a lot.
So Corey is a very close friend. And then he helped me get the book done by basically interviewing me. So we just chatted back and forth, got the audio, shipped it over. People transcribed it. Transcription is a little poor. That's why the book has some, but it comes out very genuine because it wasn't cleaned up by an editor with a lot of experience in that. So I need to do version 2.0, a little bit of a cleanup. But book conveys all the good concepts. If you want to start a fund or you want to do syndication, a lot of the questions in the book will help you through the process.
Nice. Thank you so much, Mike. You've been a great guest and provided some great content and value to the listeners, I know, and I hope they'll reach out to you. And I also hope the listeners will go to lifebridgecapital.com and connect with me and schedule a call, and also go to our group where we can all learn from experts like Mike and grow our business together. We'll talk to each of you tomorrow.
Thank you, Whitney. Thank you very much.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.